So, we think it is very hard, as Bob will tell you, to find land to buy, good land to buy. And the deals are tiny. So if you're a young entrepreneur, it's an interesting place to go because there's 50 lots at $10,000, it's $500,000. So for larger funds or big companies, it's very hard to play in those markets. But you may have to hold on to them for a while, and you better know what you're doing. It's so we think that is an interesting market, but there is a lot more competition, and we're selling something we bought in California. We bought it in February, I think, and we paid $20,000 a lot, and we just were offered $100 and something thousand a lot for 70 lots.
That's making money.
So that's not holding very long.
We're kind of in shock. I mean, I don't really understand what's going on. There are pockets of, I know what's happening. I'll tell you, in some good zip codes, there actually is a significant shortage of finished lots.
Yeah.
Mm-hmm.
So, and the home builders don't want to have multi-generational land again. They would like to just keep the infrastructure going and buy a few lots and keep the machine working until the ripple effects of all the government intervention in the housing market are much more clear to people.
Right.
But the demographics for housing are far better than people think.
Yeah.
His company's going to rock again. And it's just a question of when you buy it, not if you buy it.
Well,
Yeah.
the last stat on
I'm going to go buy your stock this morning.
I'll see you right outside. We can save some brokerage commissions.
Let's not do the trade on this. Let's not do the trade on the exchange.
Ignatius?
Yeah, I come at it from a totally different perspective of an equity investor, and my reasoning is that, as Barry said earlier, that Ben Bernanke went around in his helicopter dropping dollars around, and that has boosted, the equity markets. And if the equity markets stay where they are or they go up, then I think the opportunity in distressed real estate is over. The time was between October of last year and March of this year when Barry bought, his $10,000 plot or whatever. That's one scenario. And the other scenario could be that if the market drops sharply as it did last year and then rises again, the stock market that is, then again there'll be a small window of opportunity, and then again people who have the cash in hand and who have done their homework and are ready can go in and buy. And then the third scenario, which to me is most likely, is that the stock market drops by about 20% and stays down for the next 2 years. And then you have $2.7 trillion of commercial real estate that's going to be rolled around with the peak in 2011, and much of that has to be refinanced next year. So that will be a massive, major opportunity. So it's entirely being driven by the stock market. And as long as the helicopter is around and pumping money down, it could hold up, but there could be other issues that could come up and derail the whole thing, in which case there'll be big opportunities.
So Ignatius, staying with the stock market for a moment, in the earlier session, Barry mentioned all the REIT IPOs.
Right.
He did one in August.
Right.
What do you think about this wave of REIT IPOs? I'm sure the number, Barry, you stated was 43. It's probably multiples of that, just given the amount of work that we're seeing.
Yeah.
There are both mortgage REITs, there are equity REITs. What are your thoughts as an equities investor about what's going on with the REIT IPOs?
I made up the 43. I'm distressed to hear it's multiples of that.
Well, I was at another one of these distress conferences a little bit earlier in the fall, and somebody said something like just a handful of REITs today that are publicly traded sort of play in the healthcare space. And one of the bankers on the panel said that they were aware of 37 that were in the pipeline. So even if he was off by twofold, it's still a scary number. What are your thoughts about that?
Yeah, I agree with what Barry said, that the REITification process has pushed the risk of loss from the developer and owner onto the retail investors. And you can see that in the numbers, that in 1986, the entire enterprise value of REITs was about $10 billion. And in 2006, it was $483 billion, out of which $400 billion was equity. So you can see it's gone up 40 times or so. And what it has done is that the same REITs, because of the public currency that they have gone and raised about $35 billion this year to recapitalize themselves and strengthen their balance sheet. And then this is the largest amount that they have raised since 1996. 1996, that previous peak in the cycle. So that has, it's not some area that I would like to go in. If Barry, with his own private money, is not going, and why would I, as an equity investor, want to chase these REITs now? a lot of them are selling at premiums to their underlying asset values. Maybe there is opportunity for them to use their stock, their overinflated stock, to go and buy other things.
Yeah.
Right?
But if the credit markets aren't there, if you're a fund that you formed in 2003-4 and you were an opportunity fund, so by definition, fairly short life to it, what else is your alternative? You're not going to sell into the down markets. The only opportunity, right, is to monetize it, is to go public.
Yeah. Yeah.
That's the exit strategy that everyone has to look at.
Right.
Yep.
I mean, that's the only viable exit strategy today.
It's your version of amend and extend. Sort of like
Yeah, it's
change
the
the form
public
of your
version.
ownership, recapitalize, and hope someday you'll make money again.